Bill Lethman here for Money Evolution. In this video, I'm going to be talking about 401k plan loans. More specifically, I'm going to be talking about how 401k plan loans work. I'll be talking about how much money you could potentially borrow from your 401k plan, what the interest rate is, and how much it's going to cost you as far as a payment. I'm also going to be talking about a popular misconception that many people have with a 401k plan loan, and that is that the 401k plan loan is free because you're paying interest back to your own account. So I'm going to be talking about why that's not necessarily the case, why there's a big misconception there. And then I'm also going to be talking about what happens to your 401k plan loan if you retire or change jobs. There's kind of a looming pitfall there that you need to be aware of if you're going to take out this loan. What could possibly happen to it if you change jobs or you retire? But real quick though, before I get into the content of today's video, if you're watching this and you'd like to learn more about what we do at Money Evolution, you can go to moneyevolution.com. There we've got some great resources there covering a variety of personal finance, retirement planning topics. We've also got some links down in the description of the video here below where you can check out our retirement plan that we have called the Money Evolution Plan, and also our retirement planning program called the Retirement Time Machine. So anyway, check that out and let's jump right into the video here. So the first thing I want to talk about is with regard to a 401k loan. I think this should be one of the last things that you turn to as far as getting access to money. This should not be looked at in the same way that you might look at a savings account where you can just draw money from it as you need it. This is money that's for your retirement. You should really be leaving that money there to grow and invest for the long term, and this is your retirement funds. But if you do get into a pinch, you need to borrow some money, you don't have any other options, they do make a provision for taking money out of a 401k plan. So what that provision is, this is for the IRS rules and regulations. They're going to let you borrow up to either a 50% amount of your account balance or up to $50,000. So what that is let's say 50% of the account balance up to a maximum amount of $50,000. So to kind of say that a different way, if you had $100,000 in your 401k plan or more, you would be eligible to borrow that maximum $50,000. If you had $20,000 in your 401k, they would only let you borrow half of that, 50%, and then you could take out $10,000 as a loan. So that's very important there. The rules of the plan generally allow you to have more than one outstanding loan at a time, but it's going to be cumulative. So if you, let's say, borrowed $50,000 a few years ago and maybe you owe $25,000 still on that loan, you could be eligible, depending on your plan rules, to borrow up to another $25,000 to go up to that $50,000, assuming you still have enough capital in there to cover that. You have at least $100,000 or more in the plan. And then depending on what the use is of those funds, the plan will let you either borrow that out over a 5-year period as sort of a general purpose withdrawal, or if it's going to be used for something housing related, meaning that it's going to be an upgrade to your house, or you need it for some repairs, a new furnace or mechanical system, or something along those lines. If it's housing related, they'll let you borrow that for up to 10 years. So we're talking about a loan period that's either going to be 60 months or 120 months there. And then you're going to be paying interest. And granted, you are going to be paying that interest back to your own account, but there's really a missed opportunity there. So if you have that money invested in some investments inside the plan, maybe some mutual funds or whatever they may be, you're going to need to have that money come out of those investments. So if you had something that was growing along with the market, hopefully getting some returns every year, it's no longer going to be getting that return. Instead, that portion that's going to be covering that loan, if you're taking $20,000 or you're taking $50,000, that money is going to be removed from those investments, and the new investment is really going to be your loan, essentially. And the loan interest rate usually is tied to prime rate. Every plan is going to be a little bit different. Oh, and by the way, not all 401k plans may even offer the ability to take a loan. So just because the IRS allows you to take a loan doesn't mean that your plan is going to have that option in there as well. So the loans are typically tied to the prime rate. And so as of June of 2024, the prime rate is 8.5%. And they're going to usually add on 1 or 2 percentage points onto that. So it could be a 9.5%, could be a 10.5% loan. So let me just give you some numbers here because I did a calculation here. So if you were to borrow, let's say $50,000, so that would be the maximum loan amount that anybody would be able to take, assuming you have at least that $100,000 balance. You borrowed $50,000, and let's say that it was prime plus 1%, so you're going to borrow it at 9.5%. Your loan payment on a 60-month loan would be $1,050 per month. So now if you get paid once a month, you may see a deduction once a month for $1,050. If you get paid twice a month, you may see that for $525 every, twice a month there, basically. So it's going to be depending on your pay structure there. And that comes out after taxes. So even though the money for your 401k plan might have gone in before taxes, the loan payments, because you've already got that original tax benefit and you're just paying yourself back, that's going to be after taxes. So you're going to want to make sure that you're budgeting that in, that if you're borrowing this money, even if it is for a good legitimate purpose there, that you can handle that with your cash flow. If that $1,050 or whatever that number is that you have for the loan is going to put you even further behind in keeping up with bills, you want to really be aware of that. Maybe something else needs to change there. If you can do it for 120 months, meaning so that's got to be housing related, you can, obviously it's going to bring the payment down a little bit. The interest rate's going to be exactly the same at 9.5% either way, but if it's housing related, you can stretch that out so your principal and interest payment there would be $646 a month. So a little bit less, but then again, you're going to be paying it for 5 additional years, 60 additional payments for that, and 9.5%. It's a pretty high interest rate, so again, it is going back into your own account, but again, you're missing out on that growth. So it is really costing you real money there. The last thing I want to talk about, and I think this is something that can get some people into trouble. So if you were to separate service from your company for any reason, maybe you leave to go take another job, maybe unfortunately you get laid off, or you get forced out for some reason, or maybe you're just going to be retiring and you're going to voluntarily leave. Whatever the case is, your 401k plan is going to have some rules for what happens to the loan. Now, I have seen it, and it's, I think, a little bit more rare of a situation where the 401k plan will let you continue making payments after you separate service. Most of the time, these 401k plans are going to make you pay back the loan within some period of time after that separation, usually within 30 days or 60 days. If you don't pay the loan back, whatever the outstanding balance is of that loan, that's going to be treated as a withdrawal from your 401k plan. In fact, it's already been withdrawn, but they're going to treat it as a withdrawal for that year that the loan essentially defaults because you stop making payments on that. Why that's an issue, number one, you're going to have to pay taxes on it if this was taken with pre-tax dollars. But if you're not yet 59.5, you're going to likely get hit with a 10% penalty in addition to those taxes. And again, you probably already used the money for something else, so you may not have that money to pay back, and you may not have the money to pay the taxes on that too. So it could kind of put you further behind. You really want to understand that, or feel pretty confident that you're going to still be with the company long enough to continue making that payment until it's paid off there. So keep that in mind there for for that. So anyway, so 401k plan loan can be a way that you can get some additional funds. Again, I think it should be one of the last things that you turn to for accessing money to pay something off, whether it's to pay off some other bills. You got some credit card debt. Maybe you're helping one of your kids with something, maybe some college or something like that. This is probably not the place or thing that you want to be doing there. But if you do need to get some money from your 401k as a loan, this could be a way that you can do that and pay the money back, and it might be better than some other loan options, to be perfectly honest. So anyway, hope you enjoyed the video. Hope you got some good value out of it. Again, if you want to learn more about what we do, check out moneyevolution.com. Check out some of the links down in the description, and I'll see you back in one of our next videos. Thanks.